The close of basically what the markets are doing at the close of Monday, March 20th. So what we're going to go over today is basically what the Dow Jones is doing. We had a huge pop in Bitcoin and cryptocurrencies. Gold is doing really well right now. The Dow's doing really well. And to be honest with you, I thought it was going to be completely a flat day because what's tomorrow? Well, tomorrow is the big event that everybody's waiting for. It's what in the world is the Federal Reserve going to do? So without further ado, let's get over to my content. And I apologize, guys. I posted this at the last minute. I forgot to do this on a daily basis. I'm going to do this video every day that I possibly can. If I'm not here for the day, I'll try to post out there to let you guys know I'm not going to be doing this. But let's go over to what in the world's going on in the markets right now. So to do that, what we're going to look at is right here. But before we go to there, I'm going to show you guys what's going on in the MBS market so you guys have an idea what's going on with mortgage rates in the bond market. Because on my channel, what I try to do on a daily basis is bring you guys up to speed on real estate. And then what I also want to do is have you guys educated and learn more and more about the markets in general, because this is where our schools are failing us. They're failing us in the areas of finances. You know, many people get out of high school, even college, and don't know how to write a check. And I know that might be a little aged, but basically that's where we're at with a lot of these things. So what you're seeing on your screen right now is what's going on in the bond markets. This goes over the 10-year Treasury. It is up just a hair right now to 3.48. And that's where they are now. You can see the mortgage-backed securities market are kind of, they're down there. And I thought these were basically going to be at zero for the day, but they're down 22 and 38 respectively. This is the MBS coupon at 6.0 and the MBS coupon at 5.5. All I'm going to ask you to do on this end of the equation, guys, is if you're following this on your end, you want to follow the MBS that most closely relates to the current mortgage rates today. So we see mortgage rates in the sixes, so you want to use the 6.0 coupon. So we're seeing a negative 22 right there. We go over to mortgage rates, whether they're up a little bit. I don't know how these charts are doing this right now, but the markets are up, down, up, down, up, down. What you're seeing on your screen is Mortgage News Daily. If you watch my videos on a daily basis, this is what you're seeing. And mortgage rates are up 7 ticks. Remember this morning I said, well, you might see 0.05 up in rates based on where the MBS was at the time. We're seeing it's actually up 0.07. Guys, these are not my rates. These are actually mortgage rates published by Mortgage News Daily on a daily basis. And these are the top 6 products that they use. So let's check and see what the MBS market is looking like on MBS, the basically Mortgage News Daily. So here's where the disconnect is, and this is why I don't use this system for my live events and everything, because here Mortgage News Daily, it's lagging. It'd be like looking at the Dow Jones tick by tick or your stock ticker tick by tick, but it's 5 minutes late. Well, if you're really into this, you can't afford this. And what I try to do is call for my branches and my loan officers. I let them know what I'm expecting on rates, what they should be looking at. Should they be locking? Should they be floating? And so forth. So that's what we use a lot of this on a daily basis. You're seeing on Mortgage News Daily, it's showing it's down 58 right now. But if you go live, we're down 23. So there's a big lag right there. Let's go over to Yahoo Finance. This is where we want to kind of dissect our day, because guys, I'm on here to show you guys or teach you guys the financial markets. So if you're watching CNBC, you have, somebody's recommending a stock to you, or they're recommending this to you. Let me know. I'll give you my feedback when it comes to stocks, bonds, real estate, and crypto. I call it script or scrib, something like that. And you can encompass all those. So if you have any questions in regards to that, let me know, because I have knowledge in all these fields, but I am a mortgage advisor. You're going to see right here, the Dow Jones is up almost 400 points right now. That I didn't expect that. I kept completely being transparent here. What I thought the markets were going to do is basically be flat, because of all the banking stuff going on right now. But the good news is on a lot of this stuff is UBS is buying Credit Suisse. Yes, that is basically everything I keep looking at says it's basically a shotgun marriage. UBS had to basically step in and have Credit Suisse survive, basically for the European banks to not have a basically run on the monies. But my analysis of a lot of this, guys, is let me say this, and then I'll come back to this. Don't be completely shock and wowed over the banking systems, okay? Because look at it this way. Most people have some kind of an agenda out there, okay? They're trying to have you watch something or do something or whatever for, in most cases, you hate to say it, the good of you, but a lot of times the good of others. or maybe themselves. Okay. Here's what I mean by this is you watch TV, and I can watch analysts all over the place. And that's why I kind of boycotting CNBC right now, is there's a lot of shock and awe with a lot of this stuff. Is this going to be completely contagious through all banks all over the country and all over the world? No. Okay. The Federal Reserve is curtailing this. A lot of people are saying this is a bailout. A lot of people are saying it, calling it other names. Just because there's a bailout doesn't mean it's a bad thing. Okay. It means somebody's getting bailed out. You might have need bailed out at one time. You might have went on a binge, drinking binge and got thrown in jail, and somebody had to physically, truly bail you out. Doesn't mean you're a bad person. Doesn't mean maybe you won't do it again, but hopefully you learn your lessons. So here's what the Federal Reserve did. And this was genius. And I don't know how it's going to bite everybody in the ass, but here's what's happening in the background that's calming a lot of the markets. The Federal Reserve knows what they did. Okay, they basically did this. They skyrocketed interest rates by driving down prices of bonds. Okay, that's how it works. You drive down the prices and increase the yields. So how do you think we got rates this high? Okay, so that's what's happened. But if you're a bank or you're an individual holding these bonds as an asset to say, hey, what's my net worth? I look at my bond and I say, okay, it's worth $1 million. Well, if you really looked at today's price of that bond, it might be 500,000. Well, that's what banks are seeing right now. They're saying, "Oh my goodness, I don't have my reserves." Well, a lot of the banks were flushed. I mean, completely flushed with money, because if you watch charts that I've done in the past, you can see in 2020, 2021, people had the most disposable money that they've ever had in history. Well, people were putting that, just shoveling into the banks. The banks weren't paying any interest on it, but people really didn't care. They're like, "I just want my money safe. I want to have access to it." And that's the least of my worries, depending on all this COVID stuff and everything else going on. Well, now what's happening is rates are going up on everything. It's making things more expensive. So is inflation. Now people need money. Okay. So what's happening is, if you had to, in the short term, had to cash in one of your investments while prices are really, really low. You know how people always say, well, you don't really lose money in stocks until you sell. Well, at some point you're going to have to sell. Maybe you might not have to hold these things to maturity. So if you're forced to sell, you're going to take a huge haircut, meaning you're going to take a bath on these things. So the Federal Reserve said is, you know what? We know you guys are inundated with all this good quality debt. Well, they call it that. And it's basically treasuries and other high yielding or very high quality bonds, corporate bonds they could be. So what the Federal Reserve is saying is, bring those to us, and we'll give you the cash for that to make you solvent. We're going to charge you some, very minimal interest rate on the money that we're going to lend you, but we're taking as collateral all that stuff that you bought that's very high in quality, just to get everybody past this. So what happened I feel like I'm just keep repeating myself day after day after day, but that's what's happened. And then you had some executives that, why they would do this, they started tweeting and putting it on their social media that, this bank is in trouble. I think I'm going to go pull out all my money. Well, and then if I see somebody with $1 billion pulling all their money out of my bank that I bank with because they're concerned about their money's not going to be there tomorrow, well, sure as hell, I'm going to go to that bank today and pull all my money out. That's called a run on the bank. Okay. But here's another thing that happened. Banks aren't increasing the rate of return that they're giving us for our checking accounts, our savings accounts, and everything else. So I just did this as well with my mother. My father passed away about a year ago, and we have a batch of money here sitting for my mom to basically live on. Well, I'm sitting there waiting for her bank to increase those rates, and they're not. So now I can say, well, she's getting nothing basically on this money. So now I can move it into treasuries, maybe a CD, maybe some other investment, money market, mutual, anything that'll beat the bank's return that they're having, basically, that's giving me no returns. So people are pulling their money out of the bank because of that as well. So they're spooked on the banks not being solvent, a run on the money. They're spooked on the banks not having enough flushed reserves. And now they're basically saying, well, you're not giving me enough money to keep my money with you. Somebody's going to take my money out. So you have all these things working negatively against the banks. They're going to have to learn a lesson here and step up and manage their books like they're complaining that everybody else is doing these bad things. So that's the context of what's going on with the banking stuff. If you guys have any questions, concerns, anything, let me know. That's what I'm here to help you guys kind of decipher this stuff. So let's go back to it. Let's go to the headlines. And it's going to be nothing but, it's going to tell us about the Federal Reserve and and the banks. So this is basically what's going on there. If you see over here, now cryptocurrency is taking a little bit of a haircut today. It's down 1.78%. Why? I would say it's profit taking, because this number, if we go into Bitcoin, that where we've been just recently, let's just go to let's go to a year to date chart. Look at this. Year to date, it was down from 16,000 just, 60 days ago, if that, all the way up to 20, need my glasses on. I guess I can just read it right on the board. 28,000. Okay, so it's up 12,000. It's almost up 50%. It's up 50% or more just within the last 60 days. So there's probably going to be some profit taking there. Let's go back to Yahoo Finance and get an updated read on where the markets are going there. Investors for three big questions amid rolling bank crisis. First Republic tanks amid Jamie Dimon's led rescue talks. So Jamie Dimon runs Chase. He's going to probably try to go in there and get a sweet deal on some of these things. I don't blame him. These people they did bad mismanagements, and they don't know, they're probably going to be taken over. We have Amazon cutting 9,000 additional jobs. You're starting to see a lot of tech jobs laying off. Why? This all rolls into exactly what we've been talking about. The Federal Reserve, okay? What the Federal Reserve is, you remember when they came out not too long ago and said, we're going to inflict pain on you guys out there, from households to housing to employment and everything else. So what the Federal Reserve is doing is they're trying to curtail inflation. How do they do that? Well, they basically want you to stop spending money. So how do they do that? Well, they basically start raising the prices of everything, raising up credit limits or credit rates and so forth, to hopefully make it more expensive for you to buy. Well, look at it on the other side of the equation. You have all these companies out there that their job is to produce stuff. So they buy raw materials. That puts a lot of people at work. They employ employees to put the stuff together, to ship it, to do all these other things. Well, if you're anticipating a downturn in the market, which 80% of CEOs predicted this last November. They said in 2023, we're going to have a recession. So what that's going to mean is people are going to start buying less, because we're jacking up the credit rates and flushing out a lot of excess money in the system. And so that's what they're trying to do. So they're saying, okay, if we halt a lot of these things at some point, well, we won't need as much labor to produce all this stuff people are buying or were buying. Okay, so now you're going to start seeing a lot of people getting let go. And then unfortunately, it's happening much more in the tech sector, where I think there's a lot of extra fat than on the manufactured side of the sector. In manufacturing, I know a lot of people in that space. Automotive, manufacturing of big corporations, big machineries. I also own a company that provides industrial, drums that are shipping. These companies can't find enough employees. So we have basically a disconnect. On the manufacturing side, employers are needed dramatically, but on other sectors of the economy, there should be a kind of a layoff. And if you elected to work from home and things like that, please don't make yourself where your company doesn't need you. And don't really think that your company really can't go without you, because they can, unfortunately. And I'm not saying that to be rude. I'm just saying that to be realistic. Okay, so let's get back over to these things. But again, if you guys have any questions, please, that's why I'm here to answer these questions. So in Bitcoin, we see a little bit of a relief, or I'm saying, people are taking some profit. You can see some of the other things here. Let's go through some of the other contents. And again, Foot Locker CEO highlights China's seeking across Bed Bath & Beyond. That's nothing there. I didn't even know Bed Bath & Beyond was still around. I just want to kind of dissect a lot of the headlines so you guys can see how maybe media or marketing kind of prompts you to look into it, and then it's like, oh boy, I didn't think of that. But I want to teach you guys to read the context, read each word, so you can get kind of the take of what's going on. Let's just go through here, and you'll also want to look at, this says business, this says ad. Okay, it's an ad. You got to know the differences. Billion investor sees a self-indicated crisis in a stock picker's market. Here's what he's buying. That's exactly what I'm saying, okay? So he says, billionaire investor sees a self-induced crisis. We're all panicking. I think mainstream media, YouTubers, other social media platforms, if it causes fear, concern, chaos, they love it. Okay, so let's look at it this way. If you have a product that you own and you want it to increase in value, you got to make it scarce. How do you do that? You make people scared. Okay, so if I own shares in a bank, which I own an ETF, which is a basket of stocks that hold banking stocks and financial stocks, it's the XLF that I own, and I don't do this to suggest you buy it. I'm not like CNBC and a lot of these other companies that come out here and they pump, and then on the other side of the equation, they're like, well, wait a second, you can't recommend stocks. Well, I'm not recommending stocks. I'm just telling you what I own because I do this basically for educational purposes. So if I own a banking stocks, I would love to increase to my position by doing what? Causing panic all over the world, saying the banking system is flawed. It might crash. It might this. Did you see last week when this all occurred? Many companies went down 30, 40, 50% within a day. Many of those companies are coming back like gangbusters. You've seen some up 10, 20, 30%. People on the sidelines, like these billionaires, are sitting there saying, oh, man, you idiot investors, you're doing exactly what we're hoping you to do. You're buying high, selling low. You bought these financial stocks within the last 6 months, and now you just bailed out of these things because of this. We're kind of come in and gobble these things up because over time these will be lucrative. There will be some banks that just go defunct, and they're bad managed, and I blame their board. Okay, their board needs to be accountable. You can't always say, well, the Fed should have been involved. How about let's start at the board. Let's start at the people, the president of the bank, other entities, or the part that sit there on a daily basis or month over month basis looking at the financials, and quit pointing the finger to everybody else to say, you, board of directors, your fault. You guys should probably lose all of your money. You're paid $100,000 a year to come to 4 meetings and give us some suggestions, and you botched it. Why don't you give your money back maybe and make some of these people solvent? Okay, so that's my rampage for the day of that. Let's go back to some more of these contexts. Yellen, who is Yellen? Well, she basically is the let's say the president's right-hand person when it comes to finances. That's in its simplest terms. Powell, you can see right over here. Let me pull this back up. You can see the headlines right here. Yellen, Powell. Okay, Powell's the head of the Federal Reserve. So you got the head of the government and the head of the Federal Reserves praised fast action by Swiss officials to ensure that Credit Suisse was solvent. All right. Anything else on here? Sees Fed raising interest rates a quarter point. That's where we want to get to next. What is in the cards for interest rates, especially the mortgage? Well, I had a tough time. I actually had a consultation that I just did before this, and I couldn't find the futures, but I found something just as good. We see on the CME, which is the Chicago Mercantile Exchange. Here's what their predictions are for interest rate increases at tomorrow's Federal Reserve announcement. They're saying there's a 73% chance that they're going to raise rates by 0.25%. And I think 50% completely off the table, and then to do nothing is basically a 26% chance. So right now we're sitting at a 75-25 chance that the Federal Reserve will raise interest rates by 0.25% tomorrow. So they're going to come out around 2:00. We'll do the live at that. Well, we're going to keep our live doing it the way we always do it, and I'm going to give you what they did and what the after effect in the markets were at that time. But we're expecting a 0.25% increase in the federal funds rate. So let me now explain to you guys what in the world is the federal funds rate. Okay, it's pretty simple. The federal funds rate isn't the rate that you get for your mortgage. It isn't the rate you pay on for your car loan. It's not the rate you pay for credit cards. It is this, and this only, is when a bank, like we're seeing right now, is at the end of the day, they don't have enough money in reserves to basically be solvent, and so the FDIC doesn't step in and close them down, if they need money, what they do is they go to another bank and say, hey, I need some money to make myself solvent overnight. Well, it's not normally the case that they need much or they have a run on the bank. They just negotiate between another bank saying, hey, I need $1 million or $1 billion till tomorrow. Can you float that in my account and I'll pay you interest? What's the interest that they pay? The federal funds rate. Okay, that's it. That's the only thing the federal funds rate does. So now what the banks do is they're like, hey, well, the cost of our capital just went up, so we're going to increase the cost of capital to you guys. And they'll pass it on. They'll pass it on by short-term investments such as car loans, okay, boat loans, credit cards, personal loans. That's what they will affect immediately with this. Okay. Mortgage rates, if you follow my channel on a daily basis, what mortgage rates are tied to is not the federal funds rate, but it's actually the mortgage-backed securities. And you're seeing those right here. So mortgage-backed securities are down a little bit right now, but that's irrelevant because mortgage-backed securities is the instrument that you guys need to follow if you're in the mortgage industry, or if you're a realtor, or you're in economics, you want to know the bond markets and so forth. If you want this video, MBS Live, I love it. And it's a very cheap way of following this market, and you get a lot of this caption on the side and so forth. So if you want, if you're a mortgage advisor and want this system, you can subscribe down below. If you click the link down below, I think you get a discount for using this. That's why I use it, because I want all the tools available at my disposal so I can educate you guys. So let's go through some of the highlights that we're seeing right now in regards to this. And I'd like to go to the live stream news just to educate you guys on that front. So let's go through some of the headlines that we're seeing here. How to make sense of the mortgage rates info these days. So you can go here, and this is part of the newsletter you get from me. If you subscribe down below, it's going to give you captions like this and educate you. It'll give you captions throughout the day as well as at the end of the day to kind of recoup the week for you. So you can go down through here, and let's start today's rates coverage with the public announcement on the best way for consumer mortgage data online. And it shows you a whole bunch of stuff. So let's get out of that. First house price index goes negative. Oh, in the world, let's look at this. These are all kind of tools that I use, and if you're a mortgage advisor, I'd highly suggest you use this as well. First house price index goes negative year over year. Okay, let's see what he's saying here. This is the asking price of common house. House released their weekly common, whatever that is, today, showing a 0.2 decrease in asking house prices year over year. Perfect. Okay, here's what I like about this. It comes in great context. You can subscribe to this newsletter as well. It's not mine. It is down below. I'm giving you all these tools, and they're free. They're free to subscribe to. So basically what they're saying is home prices year over year just came in, and they're now 0.2 decrease in asking prices. So here, remember I said you got to follow what people were saying word by word by word. So a trick that a lot of people has been using over the last year is home sales are down huge, 40, 50%. So a lot of people think that's what's happening to the prices. Okay. Home sales are down 40%. Okay. Well, there's not as many homes on the market. So you can't have as much. Plus, you have people that they're higher rates. They don't want to buy houses right now and so forth. That's not talking about the price. Okay. So now you see here in price. Okay. Now, year over year, over a year time frame, we are down 0.2%. So this is another area where I kind of defunct, going back to a lot of these people that got me in trouble last year and the year before that said, Dan, you're a complete idiot. House prices are going to plummet. They're going to skyrocket 30, 40, 50% over the next year. Well, they've been saying this in 2020, 2021, 2022, and they continue to say it. I haven't been on that bandwagon the last 3 years, but now I'm saying house prices are probably going to be stagnant. In some areas go down. Some areas go down 10%. Okay, some maybe more. But some areas aren't going to get hugely affected. I just talked to a friend of mine in Pittsburgh. He's a realtor there. He deals in Pittsburgh or Pennsylvania, West Virginia, and Ohio. And he said anything 300,000 or less is flying off the shelves. When you get above that, that's when people are a little more skeptical. Now it's what kind of rate can I get and so forth. But let's getting back to this is now we're starting to see house prices starting to drop. Okay, so that's my concern right now is now is the time when they start to drop. So I've been preaching over the last couple of years saying, guys, the houses aren't going to crash. And I've been on everybody's radar saying I'm an idiot. Now we're starting to see prices come down. So be careful that you're paying attention on home sales versus home prices. And don't think that home prices are going to go down 30, 40, 50% year over year. It's home sales, the number of homes being sold. Okay, so that's that part of it. And let's just go back and see one more caption of this, and then I'll let you guys go. But if you guys have any questions, I hope I'm live streaming right now. If you guys can at least just give me a thumbs up or a check or a whatever, just so I know you guys are or have the capability of chatting with me. It doesn't look like I can see everybody on here, but I don't see anybody chatting. So hopefully you have that ability to do that, but I'm not seeing those because I would love to answer any questions that you have. So let's go back to the headlines and we'll just go through a few more just so I can keep you guys up to date. Mortgage industry to factor climate risk before lending, whatever. JP Morgan advises First Republic on strategic alternative, including capital raise. So JP Morgan, Jamie Dimon runs JP Morgan Chase. He's a brilliant guy. He'll probably step in and make a ton of money on this. Here it is. And the last but not least, we got right here, a 25 basis point rate hike is likely, but a mistake, says MKM's Michael Baroda. So here's the consensus vote, what we're seeing for tomorrow's. So I'll conclude it with this, because all the markets are dependent right now on inflation, the Fed, and everything else. Here's what it is. The Federal Reserve is going to come out. They probably are going to do a 0.25% increase. They should do nothing. And you guys might say, oh, yeah, Dan, of course you want nothing because you want rates to come back down. No, I don't. I've done this for 34 years. I hope to do this for another 10 years or plus. So I want the long-term goals of a lot of this to kind of play and stay in place. But they keep saying, inflation, and all this stuff. I think if they do nothing, they're going to lose a lot of credibility. People are going to say, see, it can turn on a dime. But they should do nothing. They should do nothing and let the dust settle, because they did enough damage last year. They created this issue. They need to have a little bit longer term duration of letting a lot of this come into place and start settling the markets. So tomorrow, they're most likely going to do a 0.25% raise. I'll give you some more text in the morning when I do my more research tonight. So check out tomorrow's morning's video. I'll give you a little bit of a beat on where I think the Fed's going to go at that point. But don't be surprised if they do a quarter or nothing, because a lot of analysts are saying, please don't do anything this time. Give it a little bit of time to work. Plus, let a lot of this banking stuff just subside and get a little bit behind us. So that is my report for today, guys. I don't know if we had any issues on the live event, because it doesn't look like anybody's posting any comments, which I usually have a bunch of them. So I apologize about that. I'll try to get it fixed on my end for tomorrow, but please join me tomorrow morning. If you like my videos, all I ask you to do is do me a favor. Do me one huge favor. Share this video. Share it to anybody out there that that doesn't want biased. They don't want a bias. They don't want, okay, well, I'm a Republican, so I got to go with this approach, or I'm a Democrat and I got to go to this approach. Come to my channel where I'm going to tell you just how it is for the best of all of us, because we're all U.S. citizens looking for the best for each other and the whole economy. So thanks for watching, guys. God bless. Please give me a thumbs up if you like my videos. Subscribe down below and hit the bell every time I post a video. You get an alert so you don't miss my live events as well. God bless, guys. See you.